Thank you very much. Thanks for coming. The challenge is huge because I'm due to do that in English. So if you don't understand me, so raise your hand and ask me to repeat what I'm saying. How many people in here are trying to raise money? Well, let's say 70%. How many people have already raised money? Good. Then we can have exchange. Please, during my presentation, ask me, interrupt me. If there is another microphone, there is another one, so you can just give them, then you can ask questions. So this is an old photograph. I won't be any more dressed like that in my life. That's when I was at the head of one of the biggest investments in Paris, which is called OTC aggregator. Then I sold it last summer, and now I'm back to entrepreneurship. My purpose today is to explain you that you have to build what I call an equity strategy. Entrepreneurs and the VC industry is facing huge challenge because we have to change completely the way we invest with people like you. And that's what I've discovered over the last 10 years. You're expecting different things. Companies are getting bigger, faster, and the VC industry is going to change, and entrepreneurs have the power. What I want to share with you is some thoughts about how to organize your fundraising and to manage your shareholders from the very beginning with your co-founders to the exit at the time you're a unicorn. Let's hope it will. That's who I am. The interesting thing about that is that this is the bright part of the moon. In front of this, you have to imagine that all the companies that I've co-founded or founded almost died 3 times before I achieved them. And this is something you have to live. And the only reason we saved them is because the shareholders had aligned interest. And I managed my shareholders because I raised about 50 million euros over the last 10 years for my own ventures. The only reason why I saved my companies is because I could manage my shareholders and convince them, all of them, that we have to pursue the game. And that's the point. This is the stories you will have of all the successful entrepreneurs. They will tell you they have succeeded on everything they've done. It's not the truth. They have failed, we have failed, and I failed 3 or 4 times before achieving that. Keep that in mind. I will tell you 5 things that's completely unuseful, but you will hear from the others. First of all, people will tell you fundraising is a full-time job. This is not true. Everything is a full-time job. You have to spend time on every subject on your business. But fundraising is not the only way. Fundraising is only the result. Managing your shareholders is a full-time job. This is the way CEOs in the United States works. CEOs in the United States, I had a discussion with Laurent a few minutes ago. CEOs in the United States do 3 things. They manage the shareholders, they're raising money, and they are hiring talents. In France, a CEO is doing everything but that. He's not hiring talents, he's not managing the shareholders, and he's sometimes raising money. It's a completely different role, and we are coming to an American part of role is changing that. The other unuseful trick people will tell you is that what we call the deck is your Bible. Deck is very important, but deck is the only expression of your vision, and the vision is your guts. It's what you have in your inside and your vision. That's what you have to share. The third thing, which is completely unuseful, is that some people would tell you that the first movers take all, and probably that's what happened in the 2000 years. In last century, when you were starting a business, being the first in the market was probably the good way to be the leader of the market. It's not anymore the case. Today, on my opinion anyway, probably if you are especially good as executing your plan, is the way of gaining the market. The good example about that is the crowdfunding industry in France. If you remember, the crowdfunding started in France 2 years ago, something like that. And there are about 70 platforms agreed in France on which you can lend or invest through internet in companies. One platform is the last mover called Lendex, started 8 months ago. The last one, and they took in 8 months the leadership of the market. And how did they do that? They went and they only focused on execution. They had the perfect UX, they had the perfect team, they had the perfect shareholders, and their whole things was perfect. And the difference between now and before, that you have to prepare all as if you become leader. When we started Viadeo, 12 years ago now, we built the company where we're working. We're walking, probably. Now you can't build a company as walking. You have to prepare all things as if you were going to be leader. This changes. The VCs will tell you to focus on the technology. Not true anymore. I mean, we have a lot of engineers in France. Technology is very accessible, achievable. The only things that counts now is customer, UX and customer. And the fifth thing, it's not the third one, sorry, the investment will do the fundraising. It's not true. The investment bank will help you structure your thoughts. They will help you get contacts with some investors, but they won't raise the money. The money will be given to you by the VCs, and this is the guy you have to convince. Conclusion on that part, very simple. You need two things. You need money to start your business, and you need an equity strategy that fits your equity story. And that's, I did that before reading the last post of Jean. But if you read Jean or Fred Lanier, you will understand what I'm talking about there, because that's exactly what the family and Jean with Schema is trying to build now. He's trying to build probably a course or a MOOC explaining how the real life is living with a VC. And that's what he announced in his last post. But really, you have to build your equity strategy as if it was the equity story of the company. Just back to basics. Just imagine the world you're entering if you're raising money. Less than 200 people in France are the guys you have to convince to put money in a business. It's very few people. I have a nice statistics that I spent 20 years in this industry. It's very funny to notice that there is a directory called the Annuaire of l'AFIC. If you know, it's a directory, professional directory. There are about 1,500 people in it, from junior investors, analysts to partners of funds. I mean, the people inside are exactly the same over the last 10 years. I mean, these guys are exactly, the VCs are exactly the same over the same, nobody has created a new fund and started a new business, a new VC fund in France. This is exactly the same population. It means that these people have the power to put the money in a company. And this is these people you have to convince. And you're in competitions. There are about 10,000 entrepreneurs a year trying to raise money. And we're all talking about BAs. We're all dreaming about BAs, large names, big successful BAs. Anyway, the real active BAs, less than 1,000 in France. It's very few, because it is the famous rule of the 20-80. 20% of the BAs you know are investing 80% of the amounts. So anyway, there are very few BAs who are able to finance your business. So if you find some, take the money. And the last thing which is important, the average age of a partner in the VC industry. The partner in the VC industry is a guy who is going to sign the check, not the junior guy who is analyzing the business, but the guy who is going to decide. These guys are around 50 years old. These guys are the age of your parents. I mean, you are creating business which change the world, and you have to convince people the age of your parents to invest the money in. Never forget that. I mean, the guys you are meeting in the first meeting are junior analysts, bright guys, but they don't decide. They are the older ones, the experienced guys, the ones who decide, are probably less sensitive than the guy you're meeting at the first meeting when you're meeting VCs. This is important. Who are you talking to? Who are the VCs? Who are the guys you're discussing with? Very important. These guys are what I call analysis brains based, which means they are spending their time analyzing what's in your mind and trying to modelize what you're telling them. KPI centric. They want to hear KPIs and understand that your business is going to provide metrics that they can understand, they can digest, and they can reproduce and give to their own customers. I mean, my customer, when I was a VC, was the guy who is providing money. He was giving me the money, and I was investing in another business. And my customer is not the entrepreneur I'm financing. My customer is the pension fund of Nebraska, who is providing me $10 million. This guy is my customer, and I want to give him a report. So I need KPI for that. Process and execution driven. That was what I was telling you at the first time. They are now process execution driven. They want excellence in execution, and they think, and I think, that it's probably the key of success in the actual world. VCs come, and that's something which is quite awkward. VCs come from audit firms, consultancy business. And when I say very rarely from entrepreneurships, I can count, I mean, we are 200 people deciding, I can count on two hands entrepreneurs becoming real VCs. You know some of them, it's very rare. Most of the time they spend their time auditing, analyzing numbers, and spending time in the consultancy business. Very important to have that in mind when you discuss with them. So they need something which is square, and they need something that ticks the cases they need. How do they grow in their own company? Because the guys are meeting, they have their own career. And how do they grow in that business? I mean, normally, a guy who is entering the VC industry is spending 3 to 4 years as an analyst or a junior investor, which means that he's meeting people, he's meeting entrepreneurs at the first site, and then he's working with a partner or with senior guys, but he's not in charge and he doesn't decide anything. Which means that when we're meeting these guys, you have to convince them and give them the keys to convince the guy who will decide, but the guy who will decide is not the same generation, so you have to get that in mind. Afterwards, he spent 3 to 4 times as what we call investment manager, which means he's partly in charge, he's managing all the process of investing in companies, but he doesn't have the decision. Even though he spent hours, days, months analyzing, convincing, he doesn't make the check. He doesn't have the decision. Keep that in mind. Probably, when you see some guys like that, he's becoming a partner 3 or 4 years afterwards. But he's becoming a partner, he have made good recommendation to the partners. And afterwards, they become partners. And there is no guide, there is no MOOC. You don't know how to become VC. This is only experience-based business. And I'll always say that. Entrepreneur and VCs is like psychotic, like schizophrenic. Entrepreneur is psychotic. Why that? Because we are all thinking about our business morning, lunch, and nighttime. We're sleeping with that. We're only thinking about raising a business, growing, hacking growth, hiring. I mean, this is something that you spend your time thinking about that. So you're psychotic, you're not thinking about that all the time. VCs are schizophrenic because they're spending their time trying to find the good entrepreneurs, and we'll explain that later on, trying to invest the money in the best project they find, but also spending our time being afraid of investing in the worst, in the bad company. So they're spending their time being schizophrenic about that. Be aware of two sentences you will hear. I mean, people have you ever heard about these sentences? I would love to have that idea. A frustrated guy who has not the guts to create his own company. And another sentence I used to hear: "It's a good business, I'll come back fast." Play the game. Convincing a VC to invest in a company is a buy and sell game. Each round, the rules switch. What I mean that is very simple. The first time you meet a VC, it will be open-minded. I mean, this 50% of the brain will be an empathic brain, and it will try to understand exactly what you're telling him. He will understand. You try to understand your market, your business model, where you want to go. But afterwards, he's analyzing exactly what you tell him, and he's spending time on the other 50% of the brain, which is analytic brain, and he will be in the other position. So each time you meet a VC during these famous rounds of meetings, the roles switch. And if he is convinced that your business is a good business, role changes. At that time, you will be in a strange position. The other thing he will tell you is, these are standard terms and we won't change it. Standard terms doesn't exist in the VC industry. It doesn't exist. I mean, if your business is a good business and it's a fundable business, you will have probably 3 or 4 proposals. If you have 3 or 4 proposals, that means you can negotiate. If you can negotiate, it means that you won't be imposed standard terms. So you can play the game. Play the game and do like if you will accept the famous standard terms. But afterwards, keep in mind that when you put somebody in competition, you can manage that later on. I have a powerful network and I provide support. So it's exactly the same theme of the blog of Jean de la Roche-Brochard. It doesn't exist. I mean, a VC is putting money in a business. He's probably helping you as much as he can, but his job is to invest money and to raise money. He's raising money, and afterwards he invests it, and he exits. Between this time, he's trying to provide as much help as he can to his portfolio companies, and it depends completely on the guys you have in front of you. If you have a guy who has been entrepreneur himself and who really believes in your business, he will be able to help you, but he will decide himself it's not part of his job. I mean, the support, the networks, anything that a VC would provide, it's a myth. There is one thing that is useful, is probably the name of the VC. There are some VCs whose name, because they had success, are better than others. That's the only thing you can expect from them. And the last thing which is important, there are some terms they want to hear, and that the terms that fit with their own trainings and their own backgrounds. Means traction, retention. I didn't put here some terms they didn't want to hear anymore. I mean, millennials is something they hate now because everybody told them that millennials are the next the next area they need to invest in, but they heard it several times. But they want to hear terms and vocabulary that they understand, that they can fit with their own business. And I was saying, fundraising is like dancing. There is a rhythm, a momentum. You have to build a tactic and keep the tactic, you have it in mind. And I will say that raising funds is quasi-biological because it's easy or it's hard. It's never between one another. Keep in mind you have no emergency. Time is probably the VC's nightmare. Keep in mind also when a VC has raised fund, he has sometimes between 4 to 5 years to invest it. So they need to push the money. They need to invest. And probably they take some decisions sometimes because they have the money to invest. And you have to keep that in mind when you are thinking about your strategy, which is try to imagine and try to know if they are in a large investment cycle, which means they have just raised a new fund and they need to invest and start a new investment cycle. Are they at the end of the investment of an old fund, which means they will probably be more selectful than they've been later. This is part of the strategy. And time is your friend. Time is not time is the VC enemy, because the VC will be afraid to invest too early in a too small business, but also it'll be frightened to invest too late because he will pay the share too expensive. And this is always what he is thinking about. And sometimes they are raising and they're keeping contacts with managers all the time, trying to find a way to keep their relationships alive in order to invest just at the time that is the best between price they'll be able to pay and maturity of the business. And never forget one thing, VCs have no IDs. There's something we know. When I was a VC, I had no IDs. I was putting money in other people's IDs. You have the IDs. VCs are only following the trends. And you are making trends. And that's really something I observed several times. What's wrong today will be right tomorrow. I've seen several times people saying, well, this is not a good business, this is probably not a good market, and you change your mind 3 months later. So if you believe in your business and you think it's the right one, keep going, and the money will come. That's what I was saying. Fundraising happens naturally. It's a biological process. The important point is, if you're feeling that, it doesn't work, you're trying raising money, the contacts are not good, people don't react, stop it. Time for a VC is probably a few months. It's nothing worse than becoming, a Loch Ness monster. You know what a Loch Ness monster is? What we call a Loch Ness monster in the VC industry is a case, so it's a business. It's a business who has come in every fund of the market and who is spending their time, and people spending their time discussing, but nobody invests. And it lasts 1 month, 2 months, 3 months. And you as a manager, as an entrepreneur, spending your time in the offices of these guys, defending your business, and you feel that it doesn't work and it won't work. And you spend your time trying to convince them. And if you're doing that, you're losing the momentum. And if you're losing the momentum at that time, that's becoming a Loch Ness monster, because people are saying, well, it's been spending 6 months discussing with all the VCs on the market and nobody has invested. It means that it's not a good business. And they're not just analyzing it. They're just spending time on it. It's just thinking, if somebody else hasn't done it, it's because it's a bad business. So if that happens and you think that doesn't fit at the moment, stop it a few weeks. Work on your momentum and come back with new KPIs, new numbers. That's what I would advise one of my investment recently now. You stop discussing. You spend time in the business. Spend time of give them other KPIs, new numbers. The traction is better. The retention is better. And they came back, let's say 4 weeks, 3 weeks, 6 weeks after with new numbers. And then it was a whole new case. This is a question of week. Don't spend time trying to convince VCs to invest the money if they don't feel it, and you don't feel it. You stop it and you start afterwards. What is a fucking equity strategy then? And this is exactly the question I ask entrepreneurs when I was investing in them. Do you really believe the dentist will tell you it doesn't hurt when you're coming down? The real life with a VC is that business angels, seed VCs, A series, B series, C series, may have not aligned interest with yours, with your co-founders, with your managers holding stock options. I mean, they may have not aligned interest. And if you're not able to manage that, that can be a nightmare. I have some examples of good business with good teams, with real traction, but they couldn't manage properly the relationship between the BA, the seed one, the VC, the Series A, B, C. And if your shareholders is a mess, you're not maneuverable anymore. You can't move. If you want to make a merger with an American company, you can't. I mean, the shareholders are this is something which is fix your strategy. If you are maneuverable, you keep your agility on, at that time, you're able to move. And this is very important. And that's what I call the equity strategy, is to be able to keep the agility. As much time as you spend on your business, and you spend it on managing your shareholders and managing your equity. This is a way to secure it. Never forget that it's your sweat and your blood. You're spending time on your business, probably working free, spending nights thinking of it. If you're not able to secure it and managing properly the other shareholders, you will lose yours. And even if, the money you'll get from this equity when you exit is probably not your chasing. That's not what I'm chasing when I created my business. But that's not what we're chasing. One time, you will probably be happy to have it. There is one thing which is sure. If you can't manage your equity, you can't manage your shareholders, don't get any money of it. Because you don't exit a company where the shareholders are not managed. It doesn't exist. And this is about exit expectations. This is very important. Be clear with your BAs. When you're starting a business, you're taking some BAs or friends and family. You tell them it's a 10, 12 years story, guys. You won't see your money until 20. When we started some business, in 2003, the first exit for the Viadeo business angels was last year when we went on IPO. 13 years. These guys had to wait 13 years to get liquidity, to get an exit. Seed VC, 7, 8 years. Series A, 5 to 7, and afterwards it's almost the same numbers. It's been 4 or 5 years, which means that you have people as partners of your business who have put money in it, who doesn't have the same expectation in terms of exit. And they have it, and they don't have it, and probably they don't have the same feeling about how they need to be managed. A BA is managed differently than a seed VC or a Series A or a large investment fund based in London. It's not the same culture, it's not the same way to speak, it's not the same expectations about the relationship they have with them. And probably the more early the guy invested in your company, the much important they think the relationship with you is important. Never forget that. It's not because you're raising $10 million with Badelton or Index Venture that you have to forget that one day, 10 years before, somebody put 10,000 euros in your business and authorized you to start it. It's very important. And that I was telling you at the first, part of the success of the business I had and the venture I had myself and the way I could save the business when we have difficulties is probably that I was respecting as much the guy who provided me, let's say, 10,000 euros when I started the business, than the fund who gave me $10 million. And this respect and this relationship and this close relationship were the key to succeed in bad situation, first, and secondly, in good situation, because it's an accelerator in terms of value creation. Unicorns has become unicorns also because the shareholders were managed. Don't forget that. And it's very clear in the American VC industry They know how to align their interest. It's very clear in the UK VC industry. It's not clear, and it's probably part of the lack of unicorns, especially in France, in Latin countries. It's not clear in Latin countries, including France. Building a company takes 7 to 10 years. And if you think that you are going to build a company and sell it in 3 or 4 years, you will be probably the 0.1% of the entrepreneurs who will succeed, and I expect that for you, it's good news. But most of us, and myself, I spent 7, 8, 9, 10, 12 years to build my company. This is the time, the real time. So that means that you really need to, one more time, manage the relationship with your shareholders. Fine, but how? Very easy. First of all, my first advice will be build a solid relationship with all your shareholders. I mean, from your grandmother who is giving you 10 euros to the partners of Balderton or Index who give you 10 millions. Very important, because the shareholders are the guys who are holding a part of your building. And when you need to move, you will need it. Always tell the truth and anticipate bad news. Tell the truth, which means if it doesn't work, if somebody doesn't work like it was expected, tell it. Very simple. And tell it fast and simply. But you tell at the same moment to everyone. It's not because a guy has put $10 million in a company that he deserves more information than the guy who has put 10,000 euros. I mean, everybody has the same information at the same moment. Anticipate bad news. When you feel that somebody doesn't work, won't work, I mean, you know in your guts. Anyway, if you know in your guts, tell it. And if it works well afterwards, it's good news. And the last thing, we didn't write here, is organize meeting with your shareholders. Make them meet each other. I spent my time, when I was my own venture, to organize meeting between them. There is the general assembly of the company, which is a legal one. But if they invest in your business, they need to understand what happens. Organize meetings regularly. And I did it twice a year. I mean, the shareholder meeting, like you here. I mean, 10 people, a drink, a microphone, some slide about the strategy, what happens, good news, bad news. And they will feel that they are part of the adventure, which makes the difference. Manage it like it was with your customer. Think really that your shareholders are your customer, and that's probably your best customer, and that's the best ambassadors, because they put money in it. You have a vision of a business, you need a vision of your equity. And I did this presentation because I noticed that I haven't seen anybody anticipating that in every discussion about entrepreneurs I had about 10 years. Make it simple. Having VC is a real chance. People change. Your business will change. You will change your business model 3 or 4 times. I mean, the guy who is representing the VC in your board will change 3 or 4 times, because that's life. I mean, this is not, when you're VC, you are an employee, an entrepreneur, and normally your career drives you in some other places. Anticipate the fact that the guy you're discussing and you have at board will change. And don't expect as much commitment of your shareholders that you have on your own business. There is VC, and probably your business engine can help, but they will help as much as possible. They won't be committed as you're committed. I mean, your grandmother, if they put 10,000 euros in the business, won't be committed as you're committed anyway. Never forget one thing. VC does his job as exit. His only objective is to give much money than mean, I have raised money to reinvest it in companies. And my success as a VC was the moment I was giving more money than I've been given to. So the only thing that counts is exit. And a good exit is a good way of managing shareholders. And that's part of the success. I gave you 5 unuseful tricks. I'll try to give you some useful tricks this time. If you have BAs, that's fine, that's good. Some of them may behave as co-founders. Make sure that they don't, and choose a leader, very useful. If you have 3 or 4 BAs, make sure they know each other, and choose between them a leader with whom you have a natural relationship. And he will be in charge to give the information to the others. It's much more easier to manage. Same thing about the VCs. If you have several VCs, choose a leader, but more important, choose a leader who can take decisions for the others, which is quite complicated, in fact, but you have to try to get that. There is no such problem at the time you have a minority VC shareholders who is unmanaged, which means who can block an exit, he can block a merger, he can block anything, even if you have 1% of the company, even if the 1 share. This is very important. Make sure that you can identify precisely who makes a decision and how long does it take to take a decision. You must keep your agility on your equity. Third, if you have large international VCs, which is good news. I mean, imagine in 5 years you have raised $100 million, which is good. Never forget the guy who put your first 10,000 euros. Never. Because this guy is probably the guy who was part of the success. And if you're an unicorn, never forget liquid pref and double deep. I mean, having a valuation of $1 billion doesn't mean anything when you have a liquid pref and double deep, but you know that. I mean, it's part of what the family does in terms of training. Last advice, from my point of view, discuss the terms you are negotiating and the contacts we have with every entrepreneur you meet. Share experience. I mean, your business is your business. Nobody is going to stole your ID. It doesn't exist. I've been doing that for 20 years. I mean, nobody stole the idea of the others. It doesn't exist. But if you have good advice from others who have lived the same situation, who could live the same situation, who have met others, or guys who have already met the people you're meeting, share as much information as you can. At that time, if you can share it with good and bad news. I mean, there are good news, bad news, and especially people who have failed, very important, and why it doesn't work. This is very useful, and this will help you not making the same mistakes. Thank you. Is there any questions?
Thank you for your presentation. So, sorry for my ignorance, but you mentioned about liquid pref and double deep. Could you elaborate on that or define it?
Sorry, I don't hear the...
Could you define what liquid pref or double deep?
What is it?
Yeah.
What is it? Well, liquid pref is very simple. When you put $1 million in a company, which is valued $100 million, which means liquid pref is, never mind how much you'll sell the company, you take your $1 million first. That's the liquid pref. You're served as in the first and at first, and afterwards you serve the other shareholders. And what we call double dip, it's harder than that, is that you have put $1 million in a company which is valued $100 million. You take your first $1 million first dip, and afterwards you take your second $1 million, double dip, and the rest of it is shared between the shareholders. And there is a triple dip with, there is some other things like that, but which means that some VCs take less risk than the valuation seems to mean they took risk. And there are some schemes, some technical schemes, which enable the VCs to take no risk. So you can put a value of $10 billion if you want, doesn't matter.
Hello. I've got a question regarding PR, public relations. What's your experience, your feedback? Can it help to talk to your shareholders, or?
What do you mean? You mean PR to manage the relationship, PR to promote your business before raising funds?
Both.
Well, PR is useful in our world. And even VCs are making PR now. It doesn't work, but PR, VCs are making PRs. Very useful to raise fund, because if you're having PR means you have a clear message. Your message is understandable and understood with people who doesn't understand anything, which are journalists. They don't understand anything. That if they're able to promote your business, means that you're able to share it and make it adopted, which is good news. PR, that's for the promotion of the business before raising funds or when you're raising funds. Very useful, and it attracts attention of the VCs. To manage the relationship with your shareholders, I mean, the CEO does it, nobody else. Very simple. So no PR. They will be sensitive to that. They will like to read some news about the business invested in the press, and they will like to read some press reviews you can send them, but it doesn't replace a personal relationship with them.
Thank you.
Hi, thank you for the presentation. Some people say about partners that they should be your friends or close friends for like 20 years or so. And some other people say, no, you just have to like them and go on. What do you think about partnership?
You mean partners in your business or in
Yes, partner in the same business, yes.
I mean, your co-founders.
Co-founders.
Okay, all right.
Well, if you have the idea, he's not exactly the co-founder. He's your partner. More like.
Your what you call partner?
Exactly.
Well, it's like in real life. You can't be friends with everybody in the world during all your life. So make a simple rule. I mean, human relationship lasts 5 to 7 years. So you have to imagine at the time you were having partners in the business that the relationship will last 5 to 7 years. And the difficult thing is to anticipate what happens when it goes wrong. And that's what you have to plan when you're starting a business. Meaning that some of them will probably become friends, 20 years friends, but some of them, not all of them, and probably 10% of them, that's life. But when you are common shareholders on a business, which means real partners, you have to anticipate the fact that the relationship may go wrong, and if it goes wrong, how do we separate nicely without having to fight for shares, something like that. And that's part of the equity strategy I was talking about. You all fine? Merci beaucoup.